Let's talk to Shridatta who's joining us from Canara Robeco on the elements which are making up the market last couple of days. Shridatta, good afternoon. Thank you so much for your time. Shridatta, first of all, purely, I know it is a very short-term factor, but election win, especially UP, important the UP as an overall election game, and how the street is now reading it, because the number appears to be slightly higher than what we were working with when we spoke to many of the street guys.
Sure. So clearly, although if you actually look at the history, the state elections don't matter so much. But when you look at, as you rightly pointed out, when you look at the intensity of win in terms of particularly the UP state, where the number of seats are fairly high as compared to what were estimated, it will boost the sentiment part of the market at least. This gives the conviction to the market that basically probably NDA is on right track because over next 2 years he'll go into the central election, and these three wins, effectively all three states they have won. Goa not so much, it's still in balance, but nonetheless it gives a clear indication that there is pro-incumbency rather than anti-incumbency vis-a-vis for the BJP as a party. And since the party has been, or the NDA government have been more pro-growth, pro-reform oriented, clearly this boosts the sentiment. But nonetheless, as I said, in 30 years there have been several elections. Central elections do matter, state elections don't matter so much. What will matter is, particularly from India's perspective, is what is happening in the energy market and commodity market, because that's where we are vulnerable to, or we are sensitive to.
Right. Shridatta, what do you make of the market valuations right now? As far as, have you looked at the reworked earnings numbers? Because there is a sense that this quarter and next, the margin impact would also be quite high. So adjusting for that, how are the valuations looking?
Sure. Thanks for that question, because this is a fundamental question which will decide the direction of market over next few months. Typically, you don't actually rework the earnings on such a short span of time, because what people are doing as of now is market is doing mark to market of the earnings impact that is possible because of the energy prices changes. Clearly, if you take today's prices and look at the earnings will get impacted to a certain extent, but that is going to happen only if the oil and commodity prices and energy prices stay here for a longer period, which means 3 months, 6 months, or a year. As of now, there is no impact. So how you should read it is without basically knowing how much time these energy prices are going to remain elevated, you already have that earnings impact playing through the valuation. So valuations have corrected to something like 18, 19 times forward earnings without changing in earnings today, because you don't want to make those changes in earnings today, given that you just don't know how much time this situation is going to persist. Most particularly the way events played out even yesterday in the energy market. So my take is even on the energy side, people will find out more sources like what is happening in particularly on the front of Iran, Venezuela, and US will produce more. And to that extent, the near-term pressure that you have seen, substantial pressure, might adjust itself as the time passes. And to that extent, we are not actually factoring in it completely today in the earnings. But nonetheless, if it sustains for 6 months, clearly there will be an earnings impact of anywhere between 5 to 10% on the Indian side.
What's your take on financials? They got compressed quite a lot, and if indeed there has to be a capex cycle to start from here, it will have to be actually led by financials. But why aren't they moving? I mean, this FIS selling thing, by when do you see all of that getting in the price?
So that's basically a question which even we are actually struggling to answer, because when you look at financials as a sector, it actually reacts to macros disproportionately in short term when the macros are vulnerable. Today, India's macros are not as vulnerable as they were in 13 or in prior instances where financials were hammered out of shape. Nonetheless, what is harming it? Second, it even doesn't have significant earnings impact. Like the negative earnings impact of elevated commodity prices will be more visible in sectors like auto, cement, etc. But it is not as kind of the financials are not as sensitive, although there will be earnings impact, it is not as sensitive. So second part is even earnings impact is not that much. So what is clearly hurting the sector is the ownership and the continuous selling from FIIs. When they stop selling, I think that's a difficult question to answer. But how we read it is India was the best performing emerging market. It outperformed most of the emerging markets massively, and to that extent, reallocation of money from the global funds is happening. As that outperformance tapers off, and it is tapering off very, very rapidly over last 2-3 weeks or a month, as that happens, I think the flows will also kind of, the pace of outflows will also stop. In fact, I would rather focus on what is happening on positive side, which is the domestic continues to kind of allocate money towards equities and in a way rightly so from medium term perspective.
Right. Shridatta, very quickly, if you could share how much is the forward earnings potential for next 2-3 years for your portfolio? What kind of earnings CAGR are you seeing 12-24 months far out for key portfolios of yours?
So for our key portfolios, we are looking at earnings growth which is superior to the Nifty or BSE 100 growth. So for example, if for financial year 23, and I'm not considering the earnings impact, possible earnings impact at this point in time, because as I said, it is too early, is about 16-17% earnings growth for Nifty for financial year 23 and another 15% for financial year 24. We are looking at 3 to 4 percentage point higher earnings growth than that in our portfolio, given that our portfolios have a little bit of tilt towards growth, and also they have higher ROEs, ROCs, and to that extent, that's the kind of earnings growth we are actually investing in our portfolios. But you have to keep actually in a way in mind that these earnings are at this point in time not taking into consideration for a longer time frame of elevated energy prices. As of now, we are largely working with about $100 of energy price assumption.
Which sector in your mind would actually give out maximum earnings delta? Things which are still not in the price, but actually if they pan out, the earnings revisions could actually be more materially higher than what the street is actually penciling, and hence the element of surprise could also be there.
So, as I said, I mean, the financials is one sector where clearly incremental earnings growth contribution to the indices is significantly higher for next 2 years, because their credit cost for next 2 years is going to be below the averages. So for last 5 years, they were above averages in terms of credit cost. For next 2 years, probably they will be below averages from a credit cost perspective. Credit growth at the margin is coming back, and the take is both. You have basically volume growth, which is the credit growth, and your lower credit costs will enable them to have superior earnings growth to market. Is it penciled in? To some extent, it is penciled in. But given the deleveraging that has already happened in most of the sectors, the credit growth numbers can surprise, assuming some of these external risks go away in a shorter time frame. So that's one sector. Others could be basically domestically focused discretionary consumption, as well as part of commodities where the earnings continue to be elevated for a longer period than what it was anticipated. Other domestically focused core sectors could be probably industrials, housing. Those would be the sectors where the numbers have been panning out far better than what they were estimated. And given again, as I said earlier, given the lag that has happened in housing in terms of replacement demand, the lag that has happened, as well as the balance sheets which are in place for corporate India on the industrial side. So those could be two other sectors where basically you could see uptick in earnings growth or surprises in earnings growth over next 2-3 years. So at this point in time, given the uncertainty that you have on external front, I would urge investors to actually look through the event. Don't get bogged down by what is happening in near term, because that uncertainty is also providing better valuation points, which a lot of people were waiting for last 6 months in market.
All right, Jay Bala is now joining us.